What's up, everybody? It's your boy Orlando, aka King Smitty, and I just want to talk with y'all today. Before we get started, go ahead and like and subscribe. And another thing before we get started, shout out to the Jaguars. Today's January 7th, 2023. We finna go play our last regular season game against the Titans. Finna get this dub. Yes, sir. Yes, sir. But have y'all been noticing that your paychecks aren't lasting as long as you feel like they should be? Yeah, running out of money before the next paycheck. Now you might not have been living paycheck to paycheck, but now you are living paycheck to paycheck. Yeah, I figured. So if so, look at what we got here for this video. Just a little recap. So I just want to talk to you today about just a few things, right? And let's look at this article right here. This is talking about inflation. And it's talking about, I'm sorry, not inflation, but CPI, Consumer Price Index. This is on the Zacks Finance. And let's just read this a little bit. Around the middle of every month, the Bureau of Labor Statistics issues a Consumer Price Index, commonly known as CPI. The monthly announcement indicates the percent change since the previous month in the average prices of the market's basket of goods and services tracked by the CPI. It is considered an indicator of inflation and one of the most important economic indicators. Consequently, the CPI affects the stock market, right? So now that we got that out of the way, CPI affects the stock market. Now let's see exactly what CPI is. The CPI components, the market basket is made up of more than 200 categories of goods and services organized into 8 groups. For those who can't see it, foods and beverages, housing, apparel, transportation, medical care, recreation, education, and communication. And there's also miscellaneous goods and services, including tobacco and smoking products, haircuts, and other personal services, and funeral expenses. And the CPI also includes taxes that are associated with those purchases of those goods and services, as well as government fees such as water, sewages, auto registration fees, and vehicle tolls, right? And it says that as a gauge of the cost of living, it gives a good idea of how the consumer's lifestyle is being affected by the prices of those common purchases. So that's what the CPI does. It gauges how us consumers, us everyday people who are going in there shopping and stuff, are affected by those prices. If the consumer cuts back on spending because basic expenses are too high, a recession usually follows, and this means lower earnings for public companies and lower prices for their stock. Have you noticed the prices of eggs are almost $10? It wasn't like that 2 years ago. Milk prices are through the roof. Bread prices are raising. Even chips are like $5 for like a bag that used to be $2.50. Everything that we consume on a regular basis is going up. Housing prices are actually coming down actually, but interest rates are going up. So although the prices might be going down on the houses, the amount of interest you're going to be paying on it is still going up. But let's keep on reading this though. Inflation. Inflation happens when there are too many dollars floating about in the monetary system. When the supply of dollars exceeds the supply of goods to buy, each dollar is worth less, so the prices of those goods increase. If you remember 2021, and I believe once in 2022, we had some stuff going on. stimulus checks. Even though majority of that money from those bills of the stimulus checks were going to other countries and helping them out, and a lot of money going to the businesses and stuff, we had stimulus checks. You had the PPP loans. We had unemployment benefits just going through the child tax benefits, whatever those was. I don't have kids, so I don't really know. I'm sorry, the name of those, but the benefits you get for having children, you even get more money. All of this was just watering down our monetary system. Just more money being created, more money being created, more money being created, right? And when the Federal Reserve thinks that the growth of CPI has been so rapid that it's inflationary, it steps in to raise interest rates and remove money from the system by increasing bank reserve requirements and by selling treasury securities into the open market. These restrictive Fed actions raise interest rates and restrict the amount of money banks can lend. This in turn makes operating a company more expensive and reduces consumer borrowing to buy goods. When the company pulls back their expansion and consumers slow spending, the economy moves into a recession and stock prices fall. Right? And that's what's been happening. And well, that's what happened all 2022, shall I say. The Feds was raising rates, stock market drops. Next meeting, they raise rates, stock market drops. As he is speaking, Jerome Powell, leader of the Federal Reserve, as he was speaking about it, rates, the stocks drop, right? So we've been seeing this happening. So it's not new, it's not surprising, but it does suck, right? So let's go a little bit deeper. Now that we know what CPI is and what can happen with CPI, let's come to this other article. When to expect the Feds to raise rates again in 2023. And if you don't know, this is Jerome Powell. He is the U.S. Federal Reserve Chairman. Yes, he's the chairman of the Federal Reserve. I'm sorry. They're looking over a few things. But the market expects the U.S. Federal Reserve, the Feds, to raise rates again on February 1st, 2023, probably by 0.25% points, taking us from 4.5% to 4.75%. However, there is a reasonable chance the Fed opts for a larger 0.5% point hike. I do believe if it's a 0.25% rate hike, stock market could drop a little bit, just a little bit. But I do feel, though, if it is a 0.5% point hike, it could drop even harder than it would, because I don't think a lot of people are ready or expecting a 0.5% hike. I think everybody's kind of expecting a 0.25% hike. So a 0.5% hike could rock the market a little bit heavier than expected. Inflation worries. Markets expect Feds to continue to raise rates early in 2023. That's probably quarter one, maybe a little bit in quarter two, due to inflation concerns. Recent data has shown that the U.S. inflation is declining after topping at a 9% annual rate in June, which was the highest we was. November CPI, Consumer Price Index, we just learned that, showed inflation at 7%. So it's 2% lower than it was, but look where it says right here. Still, that recent decline in the rates of inflation is insufficient in the Fed's view. I mean, yes, we have decreased a little bit, but it's not enough. It's not enough. The Fed wants inflation to return back to their 2% goal. And I feel like they don't care what they have to do to get it to that 2% goal. Do they want to cause a recession? No. I don't think the Fed just wants to cause a recession. Are they willing to have a recession in order to get back to this 2% goal? I think they are. I think they are willing to do it, but they don't want to do it. But if it's a price they have to pay, I think Jerome Powell take that price, right? Oops. And a robust job market. Part of the reason the Fed wants was able to be so focused on inflation fighting with the higher rates in 2022 is because the U.S. economy performed so well. So because unemployment rates wasn't that high, and like it says right here, is historical. It was just low. It was low to the historical standard. They felt like they were in a good position to continue to keep raising rates without a recession being caused. But let's look at the incoming data. A rate hike in February does seem likely. We already said we're expecting a 0.25%, hopefully not a 0.5% raise. For example, CPI inflation for December 2022 will be announced on January 12th. That's just next week coming up. And unemployment for December will be announced on January 6th. That was yesterday. I might need to take a look at those numbers, see what's going on with that. This data is unlikely to shift the Fed's position for February, but could change the trajectory of interest rates for the March and May meetings. So they're saying with these information on January 6th and January 12th, it's not going to do nothing for February. We're still getting that rate hike of 0.25 to 0.5, whichever one they decide. But if those numbers came down to a low enough spot, those CPI numbers, maybe 5%. Oh, that's really asking for a lot. But if it comes down enough, maybe they can see in the March and May meetings, in the other 8 meetings or 7 meetings, there's 8 of them total for the year. Maybe instead of going and considering a 0.5%, now they're doing 0.25%, and maybe even not doing interest rate hikes at all. Just leaving it right there, which would be like a pivot for the Feds. And when that pivot comes, the stock market could definitely run up, right? So what I've been doing is I have just been loading up on my big plays that were so far extended and pushed up after COVID's area that I didn't expect the prices to come back down that low. And they have. So like I said in the previous video, Tesla, Apple, Google, Disney, Amazon, Nvidia, those big players like that who I know is going to be making waves in the foreseeable future, I've been loading up on them. And I'm going to continue to load up on them until roughly that pivot comes. So I would say the beginning of this year, maybe the first 4 to 5 months, I'll be loading up on those plays. And if certain growth stocks show that they are in a position to take off, then I will throw some money into those, like Digital Turbine, SoFi, Bionanogenomics. It's a lot of things. But let's look at my portfolio so far year to date. And you can see, beginning of the first trading day of the year, I went down. 3%. Stock market didn't, because I am more focused on my growth plays. I'm trying to grow my money as fast as I can, right? So I went down. I expected to go down, not that much, but it happened. And as you see, I came back up and I crossed the S&P 500. And now, yes, we are still neck and neck, my portfolio in S&P 500. But if we continue to get green days, which I don't expect right now, we are in a bear market. But once we continue to have green days, my portfolio is going to shoot up faster than the S&P 500 will, for sure. Because on green days, what I've noticed with my portfolio, say if the S&P 500 goes up 1%, 0.8 to 1%, my portfolio might be up 1.7% to 2.5%. Sometimes, depending on the news, I might even be up 3%. Because as you've seen on my comparisons to S&P 500, I went down 3%. It then came right back up 3% to not only be even with the S&P 500, but to kind of beat it by a hair as of this moment. So once this market and the Fed's pivot from their inflation rates and CPI has kind of cooled, my portfolio will no longer, I feel like, be neck and neck with the S&P 500. I will take off from the S&P 500. So for you all, appreciate y'all for rocking with me so far, and let me know in the comments, what are y'all looking at? What is your number one stock that you're looking at during these Fed rate hikes? Because we just saw and read that the Fed is trying to crush the market. They're trying to make us stop buying as much, making it hard for us to get loans and borrow money, and they're making it hard for businesses to run their company. So, which in turn is going to bring stock prices down, which has been doing all 2022. So, with these stock prices continually going down, what are you buying? Let me know in the comments your number one stock that you're buying. Appreciate y'all for rocking out with me. Yo.